Hello everyone, welcome to the class of Financial Institutions and Capital Markets. Today is going to be the last class of Chapter 6. We're going to finish the third part of the Chapter 6, where we will discuss the mainly corporate bond, in particular like some features of the corporate bond, including the convertible bond and other types of characteristics. So that's the main topic for today. So let's continue. First thing we need to discuss today is about the trading. In the primary market trading, there are mainly two types of trading. The first one is called firm commitment underwriting. This is the issue of securities by an investment bank in which the investment bank guarantees the issuer a price for newly issued securities by buying the whole issue at a fixed price from the issuer. So in that sense, the investment bank then seeks to resell the securities to suppliers of funds at a higher price. So in this case, there's no risk for the issuer at all because the investment bank will guarantee the price. And basically, it's like buying everything, right? Buying the whole issue at a fixed price. Therefore, the issuer doesn't have to worry that there won't be enough subscriptions for my issue. So all the subscriptions, all the shares will be bought by the investment bank, and then the investment bank will try to sell it at a higher price. So this is called firm commitment underwriting. The other type of trading is called best efforts offering. So this is the issue of securities in which the investment bank does not guarantee a price to the issuer and acts more like as a placing or distribution agent on a fee basis related to its success in placing the issue. So basically, it's like the investment bank is just like, how to say, an agent. It doesn't guarantee the price, neither does it buy your whole issue. It's just, I'll try my best. Like, if I sell more, I'll get more commission fees. But if I couldn't sell any, in this case, the investment bank does not have any risk, right? They only earn a commission fee. But in this case, their return is probably limited because they won't be able to earn a price difference, right? But it's like the general rule in the financial market. The bigger risk you take, the higher return you will earn. So in this case, the investment bank will take relatively less risk, but they will also earn a relatively lower return. While for firm commitment underwriting, the issuing firm will face less risk, but in this case, they will probably have a lower return in the case that the investment bank will try to bargain at a lower price for the firm to issue its bond. Yet the bond probably is most likely going to be selling at a higher price in the market because clearly the investment bank is confident to do so, right? So in this case, whoever bears the risk will earn a higher return. So these are the two types of primary market trading. And then both are for like offering to the public. While the third type is called private placement. So this is a security issue placed with one or few large institutional buyers. The first two are to the general public, while the last one is to a private placement. So that was primary market trading. While in the secondary market, you see I highlighted the primary market trading. I want you to know the difference between these two. Private placement is relatively straightforward to understand, but I want you to understand the difference between the firm commitment underwriting and best effort writing. Well, for secondary market trading, I did not highlight anything. It's mainly because I know that this part is not very important, right? So secondary market trading for municipal bond is relatively infrequent. Same for corporate bond too. Treasury bond, yes, it's very active. We actually discussed that. Treasury bills, they have the largest secondary market, right, among all the money market instruments. But for municipal bond and corporate bond, it's relatively infrequent. Why is it? It's because such thin trading is mainly a result of lack of information on bond issuers, right? Because municipal bond were issued by the local government, corporate bond were issued by the corporations, none of them are as transparent as the federal government, right? So therefore, they face relatively a smaller market. So as well as special features such as covenants that are built into this bond's contract. Therefore, it's kind of such bonds are, including the bond issuers, are more opaque. Therefore, they don't have much trading. So information on municipal bond issuers, particularly of small government units, is generally more costly to obtain and evaluate. That's why the trading is very few. Although this is in part offset by bond rating agencies, but still it's nothing compared to the Treasury securities. Corporate bonds are long-term obligations issued by corporations. The minimum denomination of publicly traded corporate bonds is $1,000. Coupon-paying corporate bonds generally pay interest semi-annually. This is the same as the Treasury securities. A bond indenture is the legal contract that specifies the rights and obligations of the bond issuer and the bondholders. It contains several covenants associated with a bond issue, and bond covenants describe rules and restrictions placed on the bond issuer and bondholders. These two, the difference it's very straightforward, so I will quickly go through it. The Bayer versus registered bond. The Bayer bonds have coupons attached to the bonds, and the holder presents the coupons to the issuer for payment of interest when they come due. While registered bonds are those in which the bond is recorded, the owner is recorded by the issuer, and the coupon payments are mailed to the registered owner. Yeah, that's the difference. But this part, you can see, I did not highlight it. It's not very important. It's just for you to, have like a common sense. You just need to know it. It won't appear in the quiz. Well, and then term versus serial bonds. Term bonds are those in which the entire issue matures on a single date, while serial bonds matures on a series of dates with a portion of the issue paid off on each. And then there is a type of mortgage bonds. These are issued to finance specific projects, which are pledged as collateral for the bond issue. Debentures and subordinated debentures. Debentures are bonds backed solely by the general credit worthiness of the issuing firm, which means it doesn't have any collateral or asset to back it up. So it's unsecured by specific assets or collateral. And subordinated bonds are even worse. These are bonds that are unsecured and are junior in their rights to mortgage bonds and regular debentures. Yeah, mortgage bonds projects have asset to back it up, to act as a collateral. Debentures do not have that, but at least they are priority. They have the priority in terms of their rights to claim the ownership. Yeah, and subordinated bonds are junior in their rights in that sense. So next is convertible bonds. This is the one that I need to emphasize, and it has calculations involved with it. So convertible bonds may be exchanged for another security of the issuing firm at the discretion of the bondholder. So here's an example. In January 2020, Tesla Motors had a convertible bond issue outstanding. Each bond with the face value of $1,000 could be converted into common shares at a rate of 3.2276 shares of stock per $1,000 face value bond. That's the conversion rate, or $309.83 per share. On January 17, 2020, Tesla's common stock was trading at $510.50 per share. While this might look like conversion wouldn't be very profitable, Tesla's convertible bonds were trading at $179.28% of the face value of the bond, or in other words, that's $1,792.80 for a bond of the face value, with the face value of $1,000. So the question is it profitable to convert the bonds into common stock in Tesla? So when we see such questions, what are we trying to see? We're actually trying to see the value of the bond and the value of the stocks. So we try to compare these two. The value, the price of the bond is here. That's $1,792. So we want to know if we convert this bond to stocks, how much would it be the stocks value cost, right? So this bond, the price is this much, but the face value is only $1,000, right? So for each $1,000 face value bond, the conversion rate is 3.2276 shares, right? And right now the price is $510.50. So I use this number of shares times this stock price. I want to see if I convert, how much does it worth? How much does the stocks worth, right? So the conversion value of each bond can be calculated as the current market price of the common stock received on conversion times the conversion rate, right? So the conversion rate is 3.2276, and then the current market price is this one. So if I use $510.50 times 3.2276, I get $1,647.69. Yeah, so this is the value of the conversion value, the value of the stocks. So I compare this one with the price of the bond, which is $1,792. Clearly, the bond price is higher than the value of the stocks, right? So therefore, I prefer to keep the bond, which can be sold on the market at higher price. Therefore, it is not profitable to convert the bond into common stock in Tesla. So if in case you don't fully understand that example, here's an exercise question for you to help you better understand it. So it says you purchase a $1,000 face value convertible bond for $975. The bond can be converted into 150 shares of stock. The stock is currently priced at $5.25. At what minimum stock price would you be willing to convert? Right? So this is the bond price, right? What is the break-even point? The break-even point is when I convert, the value of the stocks will be exactly the same as the value of the bond, right? So in this case, I want at least the value of the stocks will be $975 or more, right? So then therefore, how do I calculate the stock price? I just use this value divided by the shares, right? So I can convert 150 shares. So and then I see what price should that be. So if I use that one, I can see that the price should be $6.5, right? So that's the minimum stock price for me to be willing to convert. If it's lower than that, it won't be profitable for me to convert. Therefore, the current stock price is clearly much lower than that. In this case, I wouldn't want to convert, right? Although this information we actually do not need it, because the question only asks for the minimum stock price. In this case, it's C, 6.5. You use 975 divided by 150. Yeah. So this price here is just trying to confuse you. Or if I can actually like ask you in another way. So like, well, this conversion rate has already given you. If I delete this part and ask you at what conversion rate would you be willing to convert, then you use this value divided by the price, and then you will see at least get the conversion rate. Then that will be the break-even conversion rate for you to be willing to convert. This is just a graphical illustration of that convertible conversion rate, but I'll skip that. So all you need to know is basically just like questions like this, exercise questions like this. So the next part is the other corporate bonds characteristics. For this part, you see I did not highlight it, but all you need to know is just basically the basic meaning of this concept, the one that I highlighted, or the one that in bold. So you all I want you to know is just you know what it means. Yeah. So for example, the first one, bonds issued with stock warrants give the bondholder the option to detach the warrants to purchase common stocks at a pre-specified price up to a pre-specified date. So that's what warrants means, right? So for warrants, it's a bit similar like convertible bond, but convertible bond asks you to give out your bond in order to get a stock. Well, stock warrants doesn't need you to give up your bond. It just simply give you that option to buy a stock at a specified pre-specified price up to a certain date. And then there's this one, call prevention. What does it mean? It means that it allows the issuer to require the bondholder to sell the bond back to the issuer at a given, or what we call call price, usually set above the par value of the bond. The difference between the call price and the face value of the bond is called call premium. Yeah, so that's call prevention. It gives a right to the issuer in this case, right? The issuer can buy back the bond at a certain price. So this is call prevention. And then sinking fund prevention is a requirement that the issuer retire a certain amount of bond issue each year. It's a bit like amortized loan. Yeah, so you have to pay back gradually over time, not paid all at once. Yeah, so this is like a sinking fund prevention. In 2016, state of Illinois had a sinking fund debenture issue outstanding that required that the state put an amount each year from 2032 through into a sinking fund, so that all of the 348 billion principal on the bonds would be accumulated before maturity. It's like, see, every year they have to retire a certain amount of principal. Since it reduces the probability of default at the maturity date, a sinking fund prevention is an attractive feature to bondholders. Yeah, so that reminds me. So for all these features, what I need you to understand is, you just the basic meaning of it, and you also know whom does it benefit. Does it benefit the issuer or does it benefit the holder? In other words, what implications does it for the required rate of return? Yeah, so that's all I need you to know. For example, the stock warrants, it benefits the holder, right? It gives the holder an extra option. So in this case, it will it will require a relatively lower rate of return because the holder was already compensated by this option, right? Or call prevention benefits the issuer because it gives the issuer an extra option, right? So in this case, the issuer have to pay a relatively higher required rate of return for the investor to be interested in it, to be willing to buy it. And then sinking fund prevention protects the holder, right? So in this case, the issuer can pay a relatively lower price or lower required rate of return to issue such bond. Yeah, so basically that's what this slide is talking about. That's also why I highlighted this part about like the corporate bond characteristics and how does each feature affect the bond's required rate of return. So it's like you're considering purchasing a 5-year corporate bonds as an investment. You have a choice of terms available, all else held constant. Which of the following terms would you find desirable? How does each feature affect the bond's required rate of return? And please explain. So basically, we have discussed already the first one, the third one, the fourth one, right? Convertible feature is a feature that gives the holder, the investor, an extra option, right? So therefore, it would benefit the investor, right? So investor will find it desirable. In order to get such feature, investor have to give up on the required rate of return. So it will ask for a relatively lower required rate of return to have such feature, right? So the only thing that we didn't discuss is the debentures. But let's look at them one by one again. First is the call feature, the call prevention. The call prevention favors the call feature favors the bond issuer, and unless the offers the investor a sufficiently higher rate of return, he wouldn't want this feature, right? Because the call prevention, the call feature benefits the issuer, the companies. Therefore, the investor would ask for a higher rate of return. The convertible feature allows the bondholder to convert to stock if he or she so chooses. So this may be desirable if you believe the stock will increase sufficiently in price. So that's the call prevention. Warrants allow the bondholder to purchase stock at a fixed price, and unlike a convertible bond, the bondholder does not have to surrender the bond. Offering warrants allows the bond issuer to offer a lower interest rate. Warrants may be desirable to the bondholder if he or she believes the stock will increase sufficiently in price. Yeah, so they are convertible feature and the warrants are quite similar. You invest in such securities when you believe the company or the stock are going to rise in the future. The price are going to rise in the future. Therefore, you invest in such securities. But the difference is that convertible feature will allow you to surrender the bond, to give up on the bond, while the warrants doesn't need you to give up the bond. Yeah, so that's the difference. Sinking funds help ensure that the bond issuer will be able to pay off the principal when due. So it reduces the default risk, right? If these are term bonds and the issuer sets aside money each year to ensure availability of funds when the principal is due, then the bondholders clearly benefit from this feature. Of course, this reduces the required promised yield. Yeah, so that's the sinking fund. So the last one is the debenture that we haven't discussed. The term debenture indicates that the bond has no specific collateral other than the earnings and cash flows of the firm. The lack of security adds to the bondholder risk and may imply a higher required rate of return than bonds with better collateral. Yeah, so debenture basically just means that the bond has no collateral. It's basically just imply that it's purely depend on the company's creditability, right? So there's no asset to back up that bond. Okay, so that's basically I think all we need to know in this part of the chapter. The next part is the trading process of the corporate bond. As we mentioned before, it's actually mainly OTC. So we can have a look at this part, but it's not very important. Primary sales of corporate bond issues occur through either a public sale or private placement in a manner identical to that discussed for municipal bond. Remember, we also discussed this part before. We say that for public selling of the primary in the primary market, there are two types. Remember, firm commitment and best effort. So that those two you have to kind of remember. We can go back and just remind you of what we discussed before. Firm commitment means that the underwriter, the investment bank, buys the whole issue, right? So guaranteeing the issuer a price and buy the whole issue at a fixed price from the issuer. While best efforts offering means that the broker, the investment bank, does not guarantee a price. Instead, they only earn a commission fee based on how much they sell this bond. So that's the difference here. For corporate bond trading, more or less the same thing here. There are two types, public sale and private placement. Yeah, there are two secondary markets trade corporate bond. One is the exchange market and the other is the OTC. But major exchange for corporate bonds is the New York Stock Exchange bond trading platform. Yeah, and most of the trading on the New York Stock Exchange platform, the bonds market, is completed through the New York Stock Exchange ARCA all-electronic trading system. Yeah. But actually, it's only a small amount of bond trading volume occurs on organized exchanges. Most of the bonds are traded OTC among major bond dealers. Yeah. So there are the next part is the rating. The rating I guess even if I don't discuss this part, as common sense you probably know it, but just, to make sure that you heard of it, we can go through this part together. There are three major bond rating agencies in the market as the following: Moody's, Standard & Poor's, Fitch Ratings, so S&P, and Moody's and Fitch. Each of these companies rank bonds based on the perceived probability of issuer default and assign a rating based on the letter grade. The highest credit quality represents basically the lowest default risk that rating agencies assign is a AAA. This is for Moody's, and this AAA is for S&P and Fitch. Bonds rated below triple, like capital B and double A by Moody's and triple B by S&P and Fitch, are considered to be speculative grade bonds and are often termed junk bonds or high yield bonds. So these are the bond credit ratings. They all have AAA as the highest, but after that it becomes slightly different. S&P and Fitch follow more or less the same rating. See, they are the same, but Moody's have a different way of representing the different ratings. Here is an exercise question. All else held constant, which one of the following bonds is likely to have the highest required rate of return? So which one is going to have the highest required rate of return is basically determined which one has the highest risk, right? Or which one has the least favorable features for the investors, right? Because those non-favorable features will basically demand for a higher required rate of return for the investors to be interested in them, right? So then let's have a look at all these options together. We first rule out D because this one is very hard to compare. Here it just says high quality, but we don't know the ratings. Yes, here it says municipal bond, but municipal bond are, yes, it's issued by the government, but it's local government, right? Therefore, state or local government. Therefore, it's not any superior or better than corporate bond, right? So, and here without credit ratings, it's very hard to compare. So we rule out this one and we compare all the others. In terms of credit ratings, we have two types of ratings. One is AAA, that's A and C, and then the other one is AA, that's B and E, right? So which one will have a higher rate of return? Clearly, among these two, AAA and AA, AA will need a higher required rate of return, right? Because they are lower credit rating, therefore they have relatively higher risk. Therefore, the investors will ask for higher return to compensate for that part of the risk. So it should be among B and E. Okay, let's have a look at these two, B and E. They both have call features, right? So B is AA rated callable corporate bond with a sinking fund. E is AA rated callable corporate bond without a sinking fund. So the difference lies in whether they have a sinking fund or not. Remember, the sinking fund is a feature that benefits the investor, right? Because the issuer has to pay back the loan gradually. Therefore, the investors kind of face relatively less risk. Therefore, the one with sinking fund are going to have to give up on the returns in order to get such feature. Therefore, the one without the sinking fund will have a higher required rate of return. So compare B and E, definitely E is going to have higher required rate of return, right? And for B and E, they all have the call features. Therefore, this part doesn't make a difference. But suppose one has call features and the other one has no call features, which one is going to have a higher required rate of return? The one that has the call features, right? Because call features benefits the issuer, allows the issuer to call back the bond anytime or within a specific time. So therefore, the one with call features are going to have to pay the investors a higher rate of return. to attract them. But here it didn't make any difference. So the correct answer should be E for this one. Okay, so this one is the rates on the treasury bond, and you can see that they follow more or less the same trend. The one that has lower credit ratings, this blue one, the BAA, has the highest return rates, required rate of return, right? Because they are risky, therefore they have to compensate you with the higher required rate of return. And the pink one is in the middle, that's the AAA corporate bond. And then treasury bond is the lowest one because this one has no default risk whatsoever at all. Therefore, they pay you the relatively the lowest required rate of return. Yeah. The next part is the bond market indexes. It's just the same as the stock market indexes. So indexes are managed by major investment banks and reflect both the monthly capital gain and loss on bonds in the index plus any interest income earned. Changes in values of broad bond market indexes can be used by bond traders to evaluate changes in the investment attractiveness of bonds of different types and maturities. The next part is the participants. Basically, the issuer, as we discussed before, given that we have treasury bond, municipal bond, corporate bond. So the issuers of bond market securities are mainly federal, state, and local governments, as well as corporations. But the major purchasers of capital market securities are mainly household, businesses, government units, and foreign investors. So this graph here shows the bond market securities held by various groups of market participants in 2018. Then you can see for treasury securities, more than one third are held by the business financial institutions, and then the other 1/3 are held by foreign investors. Government holds about 16%, household hold about 10%. For municipal bond, it's mainly split between the business, financial, and households. For corporate bond, it's mainly held by business financials. Okay, so basically that's all about this chapter. Thank you all for attending today's class. I'll see you next time.